we have gone through a pretty vicious cycle over the last 4 years where we went from a cycle of zero interest rates and abundance of capital available for almost all startups in this country, and funding at various stages of your progression from startup to early stage to mid stage to late stage to IPO, to a place where we are today where there's very little investment capital available for young companies and startup companies, and the IPO market just starting to reopen.
Gary Cohn provides a sobering assessment of the current funding landscape for startups. The environment has been declining for quite some years now, and as a former Goldman Sachs president, his perspective holds weight. Let's look at the current funding landscape for airtaxi startups. The sector attracted billions of dollars, and high-profile backers including airlines and car manufacturers. Many investors have bought into the promise of fast and affordable transport in the skies. If you were to add the capital already injected in the startups that make the latest Advanced Air Mobility Reality Index, the total would amount to $9 billion without counting the corporate-backed companies like Airbus, Textron, Supernal, and Honda. Despite this influx of capital, startups face substantial challenges in funding expensive developments and navigating regulatory hurdles, often leading to delays in key milestones. Vertical aerospace serves as an emblematic example, where the founder's substantial ownership stake highlights challenges in attracting external investment. The recent leadership transition shows the company efforts to instill confidence in potential investors. If it's going to work or not is still to be seen. Side note here, many people think that the challenges Vertical is facing started with the accident that happened during flight testing in August 9 of last year. But looking at the stock chart, the price was in a free fall before the accident. Privately held companies like Air are also feeling the funding squeeze. 2 former employees spoke anonymously to Forbes and indicated that Air was lacking the necessary funding to continue its prototype development. Even industry leaders like Volocopter are facing funding setbacks. Officials in Bavaria unexpectedly put on hold a decision over a package that would have unlocked 100 million euros funding from the German federal government. Lilium, another German company, is also struggling. On May the 3rd, Lilium disclosed in a prospectus filed with the SEC an offering of up to 75 million shares through a standby equity purchase agreement. This offering has, of course, the potential to dilute the ownership stake of existing shareholders, as it involves the issuance of additional shares. Lilium is already the king of dilution with 34% year-over-year growth in outstanding shares. Adding more shares will put a downward pressure on a stock price that's already in the $1 vicinity. And looking at the chart, it is really not a good time to be doing an offering. While the price may seem to be bottoming, it is making a pattern known in technical analysis as the symmetrical triangle. Symmetrical triangles tend to be continuation patterns, which means they tend to break in the direction of the initial move before the triangle forms. In the case of Lilium, the preceding trend is a downtrend. The price needs a strong catalyst that would trigger a breakout from the pattern on strong volume bars and allow for the moving average to start climbing. Companies usually make offerings when the price is moving higher and higher, so it's really mind-boggling to me that Lilium is doing an offering in these conditions. You may say they don't have a choice, and you would be absolutely right. Lilium is also exploring potential avenues for government support. On May 13, they announced that they are in advanced discussions with the French government on potential subsidies and loan guarantees. 2 days later, they announced the start of a due diligence process from a German state development bank, which would pave the way to a loan. German startups are resorting to government subsidies to stay afloat. And while it is true that access to risk capital is much more complicated in Europe than in the US, Stellantis, a European-based car manufacturer, is the main provider of capital to the US-based Archer. Stellantis led the private investment and public equity round in August of last year and continues to support Archer by buying millions of shares in the open market. Stellantis now owns 12% of Archer's capital, and it is its top shareholder. Side note here, Archer's stock price is declining despite capital infusions. Even the 8 million shares purchased by Stellantis this year did nothing to move the price. This tells you that while funding is necessary, it is not enough to reverse a downward trajectory of a stock price. There is no causation between availability of funding and stock market performance. EVE's ownership structure highlights the challenges even corporate-backed startups face in attracting investors. EVE was listed in May 2022, and Embraer still owns 88% of EVE, which means that pretty much like vertical aerospace, Embraer did not find institutions or private companies willing to take a substantial portion of its capital. This usually indicates an imbalance in the risk-reward underlined by either a mistrust in the business, an issue with valuation, or a combination of both. Ehang stands out among all of these funding struggles, buoyed by government support and nascent revenue streams. This is a summary of the financial runway. It shows that Vertical and Lilium may run out of cash in Q3, which is around the corner, so we shall see. Let's look now at the ownership structure of these startups. And let's start with institutional ownership, as this is the smart money. And one thing is for sure, by and large, never bet against the smart money. We are talking about the likes of BlackRock, State Street, Vanguard, etc. Archer and Joby have more than 35% of their shares owned by institutions, which is a healthy level for non-revenue generating companies, followed by ehang at 14%. Lilium and Vertical, two companies struggling with funding, are at 6% and 1% respectively. Such low levels can induce negative market perception. The situation of Vertical is particularly dire because in December of last year, Invesco, a renowned institution, liquidated its position in Vertical. 5 million shares gone just like that. I really think the smart money is smart because they know when to take their losses and move on. They are disciplined. In contrast, individual investors usually do not have the guts to take their losses or the discipline required in stock market investing. And that's why they are left holding the bag. Talking about individual investors, they are the biggest holders in ehang and Lilium. And while ehang may be in an uptrend and backed by the Chinese government, it is a controlled entity. The founder and CEO, while owning only 31% of the shares, controls 81% of the voting power. I'd bet a Benjamin and a donut that 99% of the individual investors in ehang do not know this fact. A Benjamin and a donut. Vertical and Eve are also clear outliers since the founders were unable to find investors and are therefore keeping a substantial share of the companies. You honestly don't expect that level of ownership in publicly listed companies. So what's the way forward? First, I want to be clear that I do not wish any of these companies to go bankrupt. In an industry struggling to attract and retain younger generations, the last thing we want is for some startup to fail. However, bankruptcy is a potential outcome for some companies and should not be dismissed. So in the absence of private investors, struggling companies need to convince their governments to bridge the gap and provide financial support. Another alternative is a sale to a legacy aerospace OEM or a latecomer to the airtaxi field. Or even better, a sale to a deep-pocketed investor who can fund the endeavor over the long term. Consider the UAE, who are actively positioning themselves to pioneer air taxi services. For struggling companies, this presents a unique opportunity for acquisition. Why would the UAE want to pay a premium to Joby and Archer when they can own an OEM? The same goes for Saudi Arabia. So in summary, the lack of funding is delaying the progress of the flight testing, and the lack of progress is not enticing investors to fund the ventures. It's a catch-22, and given the funding landscape, it may get worse before it gets better. Personally, I will be tracking institutional ownership in all of these companies, as it is to me a key indicator, if not the key indicator, of the trajectory of an air taxi startup, whether it will thrive or dive. Talking about water activities.
You don't find out who's been swimming naked until the tide goes out.
Beautiful analogy here from Warren Buffett. He is describing in his own style the consequences of what Gary Cohn said. The tide of funding has gone out, and we are now discovering those who have been swimming naked. I personally think that they are all swimming naked. All of them. It is just a matter of who still has clothes left on the shore. If you liked the video, share it with your friends, give it a thumbs up, and subscribe to the channel. See you in the next one.